Next up, I want to take a look at two fashion stocks, and let's start out with LVMH. A little bit of French business. Je t'aime. My wife is French, so I have a little predisposition towards the French, even though from a business side, I hope she doesn't hear me. They're quite not too good. Okay, again, same three questions. Can we buy a great business for a great price, and can we reliably predict it for the future? First up, the debt to cash situation. Cash and short-term investments, we're looking about 13,500 in cash and short-term investments. If we compare it to their short-term debt, okay, they can pay off their short-term debt. It's not the best cash to debt position, but it's still positive. So I'm happy to see this. I'm okay with this. Next up, let's take a look at their cash flow statement for the last 4 years. Yeah, it's going like this. If we add a few more periods to this, we see significant cash flow growth. So they manage to increase their revenue, and from that revenue, they can keep more cash. And this cash flow they can reinvest into their business. And we'll be taking a look at how they reinvest into the buyback shares. But right now we see a growing cash flow from the beginning of the period we can look at. It's grown quite significantly, but the last 4 years, yeah, this year to this year is still growth, then massive growth, and then it has slowed down, and it looks like it's picking it back up again. If we take a look from a quarter, there's no 2025 data yet, so that's not too interesting to look at right now. So cash flow relatively stable. Let's take a look at our income. Continues to grow. 2023 to 2024 was a slow year for them. Their cost of revenue, it has increased slightly from here to here, and the gross profit has dipped. So they've become a little less operationally efficient. Their cost has increased more than their revenue has increased, or their revenue has decreased. So that's not too surprising. Look at the EPS. Yeah. Are they operationally efficient? Now they do get to keep about 15% in cash. Let's look at their return on invested capital, which is 10 plus. That's quite good. Again, ideally, I like to see something in the 15s, but if they do share buybacks, that is another way your stock, your ownership, your stake of ownership in the business can increase. This is not a bad thing to look at. Will we see some revenue growth? Last year was tough. The 2025 data is not yet in here. If we look at the last 5 years, it has been great. And then more recently, it's been down. And this is something I love looking at. I like a business that has a very direct problem that pushes the share price down. And then your job as an investor is to find out what that problem is and if this is something that they can solve in the short term, yes or no. If they can solve this in the short term, it could be a great investment because your share price is dropped. The risk, if the price drops, there's less room for that to fall and there's more room for that to go up. So your risk has decreased. If you buy a great business at a great price that you can reliably predict for the future, if you can answer all those three correct. So a depressed business that has a solvable business problem is a great investment case. And right now we see a business that has shown really, really, really good growth, but recently is experiencing decreasing growth and even a revenue decrease. The return on invested capital is also decreasing, but still around 10%, so not too bad. Their cash position is great and remains great. So from a liquidity perspective, they're doing good. And they're buying back some shares. And it seems like the share buybacks have increased, which is great because the share price has dropped. And that's what you want to see. If a company does share buybacks, you want them to buy back their own shares for low prices. So if the stock price is down, that's a great opportunity for them to buy into their own business. Let's see if they talk about their own challenges and how they look at the future. This is our due diligence is our AI algorithm that screens all the last earnings calls. It takes all the important information and the sentiment that's being discussed on those earnings calls, and it summarizes it to you as a retail investor to look at and to see if this is a business that's worth your time. Now, never go out and buy something because somebody on the internet says it's a great buying opportunity. Never ever do that. Don't buy something because I tell you to buy something. Always do your own due diligence. But this tool allows you to quickly scan if a business is worth your time or not, whether it's something you put on your watch list or whether it's something that fits your investment criteria and that fits your style of investing and that fits what you want to reach for your financial future. Now, if we look at our due diligence, I think most of us know Louis Vuitton, luxury goods like fashion, cosmetics, wine, for affluent consumers. And a lot of those affluent consumers are in China, and the Chinese economy is slowing down. So I think that's where the problems arise. Their business model is built on exclusivity and brand prestige. They earn money through high margin products and selected retail investments. LVMH has a strong brand portfolio, including Louis Vuitton and Christian Dior. These brands maintain high quality standards. I think we can all agree this is still very true. This creates quite a nice moat. They had a 3% revenue decline in the first half of 2025. Their operating margin remains robust. Now, that's what you want to see. If their operating margin remains robust, it means the business can still continue to operate even if growth slows down. So I'm not yet sure whether we can call it great business, but it looks like a great business in the making. The company shows compounding momentum, especially in fashion and leather goods. 19.1 billion in they're doing some big numbers, despite a 7% organic decline. They focus on product innovation and strategic investments to drive future growth. They expect a recovery in wines and spirits. Yeah, it's expected, but not yet realized. They're optimistic about long-term growth. They usually are. They emphasize structural efficiencies to boost profits when market conditions improve. I think that's a great way for them to position themselves. They can't really influence whether or not the entire market or when the entire market will improve, but they can position their business in such a way that it's that it is run very operationally efficient. And as soon as demand picks up, they can produce the quantities necessary at great margins and therefore massively increase their own cash flow. And that could be a great investment case. They also highlight strong local demand in Europe and the US with an expected rebound in mainland China. And China is a key factor here. Revenue fell 3%, but margins remain strong. Okay, that's nice. Fashion and leather goods still dominate. Okay. Yeah, I think this is a great business. It's a very strong brand. They have a good cash position. They have very low debt. Their return on invested capital is great. They buy back their own shares. They've shown free cash flow growth across the last few years. If you look at their average revenue growth across the last few years, this has been positive, but it is a company that's in a slump. And it's a great business, but then it becomes more important. Can you buy it for the right price? If you can buy it for the right price, you can wait it out. And if everything improves, then you currently see growth pick up, your multiple could pick up, and you could look at a great investment. And it's a great business. Is it a great price? If we look at a PE, you're paying a multiple in relation to the earnings of 25. And their growth over the last year has been negative. I would like that to be a little bit lower. The same for the price to free cash flow. Their yield numbers are around 4%. In Europe, the interest rates are around 2% currently, so that's your risk-free rate. They're a little higher, but not too much. You do get a dividend. There is the added compounding effect of them buying a little bit of shares. It's not really enough. Let's use our discounted cash flow analysis. And here we can calculate whether something is overvalued or undervalued based on our own assumptions of how the business is going to do in the next few years. Now, we have seen 18% revenue growth in the past. That's the business record, but we already see this is being depressed. So we do a 10-year analysis. Let's say for the next 5 years, it continues to be best case scenario. Let's say in the next 2 years there is no growth, and then they managed to go back up to, let's say, 15%. So let's average it out to 11. For the normal case, I think 5 years, maybe no growth, slowing down growth, and then it could be around 8%. In the worst case, it's not going to pick up at all, and they only managed to grow 3% year over year over those 10 years. I want to pay an exit multiple of around 15, 10, and 5. I'm willing to pay market average for 10% growth. I think that's fair. If they show less growth, I'm willing to pay a lower multiple. And if they show barely any growth, I'm not willing to pay much at all. And I do want to keep 15% return. Now, are these fair assumptions? I think we can correct this up a little bit more. Let's go to 12, 8, and 4. And then let's go to, no, we keep this like this. Boom. 154. Currently is 500. It's still overpriced. So great price. No, could be something to put in your watch list if the price continues to drop. I'm willing to buy into this. If we look at predictability factor, you are dependent on China and whether or not the economy there picks up. You are dependent on fashion trends, and that's not my strong suit. I'm not too good at predicting what would be the next big bag to buy and where the fashion trends in the future go. So if you can, this might be an interesting thing. And the third thing is whether or not you can predict whether they can be operationally efficient and they can, with a decreasing revenue, keep afloat. And I think that prediction for me is a little easier to make. You see, they already keep their operational efficiency very high, even though they sell less. They have a lot of cash. They manage to buy back shares. So I think on that part, it's okay. But from a predictability perspective, there are too many factors outside of their control to really reliably predict where this exact business is going to go. And I think LVMH is currently downbeaten. They've been a lot higher. I think their Moët used to be extremely strong, and I think that's why people are paying a high multiple for it, even though there's currently no growth on the revenue side. This is something to be careful of, but to be interested in. And as Warren Buffett always says, be greedy when others are careful and be careful when others are greedy. And right now, I think people are not careful enough when it comes to this stock, and I can wait being greedy. Now, one of their competitors, Lululemon, which is another fashion stock, is also down a lot. And I've recently read an article in the news about the decreasing interest in athleisure wear, as it's called, during COVID. This entire fashion phenomenon increased. Everybody wanted to walk in leggings all of a sudden, and Lululemon apparently was the brand of choice. And they have become less popular now, and therefore they are down on the market. And to me, if you look at it through the lens of that news article, it seems that the fashion trend has decreased and therefore the stock price has decreased. And what I usually see is that the stock or the news follows the stock and not the other way around. So if the stock drops and we see decreasing revenue growth, then you see news outlets looking for an explanation, and then they come up with something like this instead of it happening the other way around. They see a changing trend, they report about it, and then you see the stock price drop. Now, why is this important for you to know? It's very easy to get taken along in the hype that's being created by media outlets. Don't do that. Do your own analysis. Look at the business. It is a great way to look at businesses that are depressed. And like I said before, I like cases where a business is depressed, but they can turn it around. It could be a great investment case, exactly because it's depressed, and that's a contrarian view. But as a value investor, I think that's a very good way to look at the stock market, to look at your feed and see the world through that lens. If you see something down, that's exactly at that point. That's why it's interesting to look at the business and see if they have a problem that they can turn around. Let's see if the business is great, if you can buy it for a great price, and if you can reliably predict it for the future. And that's where our software and our community comes in to help you making that decision. Now, once again, we're going to ask our 3 questions. Is it a great business? Can we buy it for a great price? And can we reliably predict it for the future? We've just looked at LVMH and now Lululemon. Let's start out with our growth statistics. They show more growth. They don't show a decrease in revenue, but they do show decreasing growth. Over the last 5 years, they've grown about 25%, but they had crazy good years coming from COVID. And currently, they're still growing 10%, which is great. Their free cash flow has grown exponentially. And last year it's negative, and then 3-year average is at 200. Okay, I'm already getting a big question mark. You see some dips and some gains. It doesn't look too stable. The return on investment capital is very, very high, above 15%. That's what we like to see. And the cash position is also very good. And they buy back shares way more than LVMH. They have a better cash position than LVMH. They have higher return on invested capital. They have a higher free cash flow growth, and they have higher revenue growth. So from the outset, this looks like the better business to buy. But let's dive into the details. Their most recent return on invested capital was even higher, 28%. Their net margins are about 18%. Their gross margins are 59%. Now, for a producing company, this is still relatively good. We just looked at some software businesses. We looked at Adobe and Figma. They were around 90, but that's for software. Right now, we're looking at fashion brands. LVMH, I'm not sure what their gross margin was, but they had a net margin of 22%. And we see here a net margin of 17%, which is a little bit lower. But if we look at other statistics, I still think it's a relatively good business. Cash to debt is high. Usually you would want to see it a little bit lower, but because they buy back their own shares, they seem to be able to spend this cash in a good way. And I think for a fashion brand, that can be, if the fashion trend turns around, you can have a bad business, and then having some little fat on the bones to get you through the hard times might be a good business strategy. And they don't pay out a dividend. They manage to grow their own business, so I don't really need a dividend. Their return on invested capital is higher than 15%. Now, if it would be lower than 15%, I would be interested in a dividend, because that way I can reinvest the money for a higher rate of return myself than they can get out of it. But because they have a high return on invested capital, I'm not too worried about having a dividend, yes or no. Okay, let's start out with the balance sheet and look at the short-term investments. About 2,000. And if we take a look at their short-term debt, 275. So they can almost 10 times over pay their short-term debt. So from a liquidity and solvability perspective, great business. Let's look at it from a cash flow perspective. Let's add a few years, a few periods, and we can see year-over-year growth, decrease, growth, really big growth. This is probably the COVID year, 2022. Yeah. And then it went back to 2020 numbers, and then it managed to grow exponentially, and they managed to keep on to that growth for the 2025 financial year. Yeah, the first half. Quarter to quarter, you see it fluctuate, but this is a fashion brand, and each quarter has its own peculiarities. I would expect their last quarter to always be their best quarter, their first quarter to always be their worst. You have extreme seasonality in these numbers. So seeing some fluctuation from a fashion brand, it's not a bad thing. It's not a bad thing. So overall, I think the cash flow is growing. It's relatively stable. So from this perspective, I'm happy, and I think we can call this a great business. Now, if we look at it from a price perspective, can we buy it for a great price? Now, once again, if we look at price to earnings, this is about 28. I think LVMH was about 40, which is crazy high, if I'm correct. No, LVMH was 25 as well. And Lulu is 28. So this is higher, but you do actually get growth, both on the revenue side as well as on the free cash flow side. They have a higher return on invested capital. So I'm willing to pay a higher price for their earnings. And this high multiple doesn't scare me too much. They don't pay a dividend. Their earnings yield, not very high. Free cash flow yield is not very high. Maybe this is about fairly priced. Let's put it into our value versus price calculator or DCF calculator. Now they've managed to grow about 26%. Let's say they can keep up growth in the double digits, high double digits, in the 20s. Then they average out about 15, and then they go to 10. And then we're willing to pay a little bit more for this. This is market average, and then we're willing to pay a little less. No, I think I'm willing to pay 25 for 20% growth over 10 years, for sure. And then this would go to 20, and this would go to 15. I'm aiming for a 50% return. Boom. It is currently priced at 167. Yeah, we have about 100% upside given 10 years. So I think it's undervalued. I think we can buy this for a great price as well. Now, from a predictability perspective, in my mind, this is a lot easier to predict. It's the US market. It's a lot closer to home. They also sell here in Europe. I think that's easier to understand. They're less dependent on China, or they might not. I don't think they sell a lot in China at all. To me, that makes it easier to predict. I think you still see growth. They have a good cash position. They buy back a significant amount of their shares. I think this is a stock I would put on my watch list, and I would want to investigate further to see if it actually fits my criteria. Right now, it's a great business that we can buy for a great price, and that we can reliably. There's still the fashion element. I'm not a fashionista, so it could be quite. There could be another competitor on the rise that I don't know about that could take over a large share of their market. But right now, I think it's okay. Uh, it's not entirely the stock for me, but I'm going to put it at my watch list for sure, for sure, for sure, for sure, for sure. Maybe if it drops a little further, has it already? What did it do year to date? It dropped about 54%, and it continues to decline. Now, once again, price matters. Usually, fashion is not my market of choice, but I think given that this company is currently in a decline, it can quickly turn around, and that could be they could have had a few bad quarters, and I think Q4 usually for these type of businesses would be their best. It could be an interesting play. I think I'm going to put it at my watch list, and let's see at what price it's currently on there. Lulu is currently at the current market price. I want to put it a little lower. Let's say if it goes to 120, then I become more and more interested. All right, so we looked at LVMH, we looked at Lululemon, and we already managed to find some differences, even though on the outset, if you hear Louis Vuitton, you might value it a lot higher than Lululemon. But if you look at it from a business perspective, I think Lulu is the better business and is the better stock to buy on the surface. Now, once again, don't go out and buy something because I tell you to buy something. Do your own due diligence, look into it yourself, and buy something because you believe it fits your process, it fits your risk profile, and it fits what you want to achieve for your own portfolio, for your own financial future, and your own financial freedom. And once again, our software allows you to get all the information you need, and also here over in the community, we can answer all your questions and help you reach your financial goals.